I'm Aarti Krishnan and you're watching A to Z of stock market investing. Today we'll discuss ETFs or exchange traded funds. Globally, a war is on in the money management industry between actively managed funds and exchange traded funds. Basically, in recent years, ETFs have been managing to draw a lot of money away from actively managed funds. ETFs are mutual funds that trade on a stock exchange instead of being sold or bought by the fund house itself. So basically, how an ETF is created is this. Large institutions who want to buy creation units of an ETF, they approach a fund house and trade in stocks, bonds or gold in kind and get creation units in return. So as a result of this, an ETF gets launched and then the units are listed on the stock exchange and small investors like you and me can go there and buy or sell units in the ETF. ETFs own exactly the basket of stocks and bonds that an index holds and try to mirror the returns that the index makes. They try not to deviate from the index even by a small fraction of a percentage. The first reason is they come very cheap. When it comes to actively managed funds, fund houses employ star fund managers who are paid fancy pay packets. But in the case of ETF, all the manager has to do is to own a basket of stocks that is exactly the same as the index. Therefore, the costs of ETFs are very low. In the US, typically ETFs charge 0.5% of the assets as fees. In India, they charge 1% or so, whereas actively managed funds would charge you 2.5 to 3% as fees. Secondly, you can buy an ETF and replicate an asset that you don't track very closely. Suppose you feel oil prices globally have fallen very sharply. You can go to the US and buy an ETF which tracks oil. So it will basically invest in the underlying commodity and give you exactly the same returns as crude oil. The third reason to buy an ETF is that often actively managed funds, despite the fancy fees, do not manage to beat the index. In the US, we've seen that 80% of the actively managed funds don't actually meet the Dow Jones or other indices. Therefore, investors wanting to save on costs and make sure that they beat the market, they can go and buy the ETF. ETFs declare a value called the net asset value every day. That is the value of units in their portfolio. Investors who invest in the ETF can track their returns based on this NAV. However, when you want to buy or sell units, basically the market price is what matters to you and that has some relation to the NAV, but it can be at a discount to the NAV or at a premium depending on whether there's a lot of demand for the ETF units. We are doing famously. In the US, actually last year, ETFs attracted more new money from investors than actively managed funds. Some of the large ETF houses like Vanguard and BlackRock are today much larger than the actively managed houses like Templeton or Fidelity. However, in India, ETFs have not done as well as they have in the US markets. In India, we have a very limited set of ETFs. Basically, we have gold ETFs, Sensex and Nifty tracking ETFs and other ETFs tracking other indices like say Junior Nifty or S&P 500. But it's not become a very large asset class because in India most managers are still managing to beat the indices by a large margin. If you feel that the dollar will keep appreciating against the rupee, you may choose to take a fund where the effect of the exchange rate is hedged out by the fund manager. That is a currency hedged ETF. Similarly, now you have smart beta ETFs. You may be unhappy with how the Sensex is constituted and feel that Reliance Industries should not be a 7% weight in the Sensex. So smart beta ETFs slightly reconstitute the index that they are tracking. They may have an equal weight to all the stocks in it and that may be used to run an ETF. That is called a smart beta ETF. A third kind of ETF is the one which allows you to benefit if stock prices or bond prices fall. Currently, all of us who invest in the stock market or in equity funds are forced to only buy funds and do well if the markets are consistently going up. But what happens if there's a prolonged bear market? In that case, you may like to own a fund which keeps benefiting every time stock prices fall. So there is a category called short ETFs which benefit every time the prices actually fall. So they work on the basis of leverage and give you double the returns every time markets fall, or 3 times the returns every time markets fall. So these have been a very popular category of ETFs globally.